You open YachtWorld and it hits you immediately. Two catamarans, same model, same year range, same size, same layout on paper. One is listed at 900 grand, the other is 450, and your brain goes, okay, what am I missing? Is the cheap one a scam or is the expensive one delusional? This is why catamaran prices feel like they're glitching right now. It's not random. It's not just the market. It's a bunch of invisible costs and invisible risk filters that got switched on at the same time. And once those filters exist, two cats that look identical in photos are not the same asset anymore. For years, we were in a one-direction market, especially 2020 to 2022. Everything went up together. A rising tide lifted all hulls. If it floated and had two hulls, it got expensive. Supply chains were a mess, factories were backed up, charter fleets were holding onto boats longer, and buyers had cheap money. So prices climbed in this weird, uniform way. Condition mattered less, age mattered less. Even mediocre boats got pulled upward because there just weren't enough boats to buy. That era is over. Now we're in a fractured valuation market. The nicest way to say it is volatile. The real way to say it is the market split in half. There are investment-grade catamarans that still behave like valuable assets, and there are distressed catamarans that behave like liabilities. The confusing part is that both are sitting on the same listing sites next to each other with the same hull shape in the photos. Here's the first invisible force. Cheap money is gone. In 2021, lots of people could finance a big chunk of a $700,000 cat. Rates were low enough that the monthly payment didn't feel insane. Now that same buyer goes to a lender and the math is different. Marine loan rates living around 8 to 12% changes everything. Not a little, everything. A payment that used to support a $700K loan now supports something closer to $350K or $400K unless the buyer doubles their down payment. Wages didn't double, so the pressure goes on to the boat price. That's why you're seeing this weird dead zone in the middle market. Sellers list like it's still 2022, buyers shop like it's 2026. Boats priced for the old finance world just sit. Boats priced for the new reality actually move. And from the outside, it looks like pricing chaos, but it's really a buyer pool collapse. Because financing doesn't just reduce demand, it deletes a whole category of demand. The aspirational cruiser who needs a loan, the couple trying to make the sabbatical work, the retiree who wants to stretch into a nicer boat with bank leverage. When rates rise, those buyers don't just negotiate harder, many of them disappear. So who's left?
Cash buyers. And cash buyers right now are playing a completely different game. They know they have power. They know listings are stacking. They know some sellers are bleeding cash monthly, so they're asking for and getting massive discounts off asking. Meanwhile, a different group, the high net worth buyers, still buy at the top end because they're less rate sensitive and often don't finance the same way. That's the K-shaped thing you feel in the listings. The top stays sticky, the middle gets punched, the bottom falls out. And that's only the money side. Now add the second force, supply. The catamaran market is getting hit by a triple wave of inventory at the same time. Ex-charter boats exiting, COVID buyers exiting, dealers drowning in new inventory. Let's talk ex-charter first, because this is the biggest anchor dragging prices down in the 40 to 50-foot production segment. Charter fleets run on a cycle. 5 to 7 years is common. Big fleets bought a ton of boats around 2019 and 2020, and then the pandemic chaos stretched some programs, and now demand surged, and now those boats are aging out. So you get a flood of nearly identical commodity cats hitting the brokerage market in clusters. Lagoon 40s, 42s, 46s, Leopard 40s, 45s, Fountaine Pajot, Lucia, Isla. Same layouts, same charter spec, same wear patterns. When hundreds of similar boats show up at once, buyers don't have to compromise. They cherry pick. They pick the cleanest one, the best maintained one, the one with the lowest engine hours, the one not in the hurricane box, the one with a decent survey history. Everyone else becomes the "why would I buy this one" boat, and that forces price competition. Here's the brutal part. Ex-charter boats set the psychological floor for a model, even when they're tired. An ex-charter 2020 Lagoon 42 listed at $350K becomes the number buyers anchor to. It doesn't matter if it has 5,000 engine hours and 1,000 little scars and a rental-grade interior. That listing sits right next to an owner version listed at $550K, and the buyer's brain goes, "Why is this one 200 grand more?" And the owner says, "Because mine is nicer." And the buyer says, prove it. And the market says, you don't get full credit for nicer. You might get some, not all. Owner version versus charter version is not a small thing on cats. It's massive. Layout alone changes value. A 3-cabin owner's version can command a real premium because it's what private cruisers actually want. Lower wear, different use case, better resale to the next private owner. Charter layouts can be liquid because there are many of them, but that liquidity often comes through discounting.
So you get this strange situation where the same model has a 30 to 40% spread depending on story, layout, and history. Now layer in the COVID buyer wave. During the boom, a lot of first-time owners bought boats because it felt like freedom, work from anywhere, escape, outdoor life. Then the world reopened, work got less flexible, and boat ownership turned into a monthly bill they didn't really want. Those are not patient sellers. They're not romantic about it. They just want the cash burn to stop. Dockage, insurance, maintenance, storage, it adds up fast on a cat. So they capitulate, they cut, they take the hit, they move on. When ex-charter inventory and COVID inventory hit at the same time, you get an oversupply shock, and the mid-range segment is where it lands hardest because that's where most of these boats live. Now, the third supply force is the one people almost never talk about, dealer distress. Dealers finance inventory through floor plan lending. When rates were low and boats moved quickly, carrying inventory was manageable. In a high-rate world, every unsold boat is a monthly bleeding wound, and lenders don't just charge interest, they often require curtailments. That's when a boat sits too long and the lender says, great, now pay down principal too. So if a dealer has multiple new cats sitting, the cash demands can get ugly fast. What do dealers do when they're trapped? They dump. They discount new old stock. That might be a 2024 or 2025 build that's technically new but has been sitting. They throw incentives at it. They do below-invoice deals. They bundle options. They do quiet pricing so they don't officially nuke MSRP, but functionally the market price drops. And the second a brand new boat gets discounted by $150,000, the entire used ladder collapses beneath it. Because why would a buyer pay close to new money for a 2-year-old cat with no warranty and unknown sins if a new boat is suddenly in range? So the used seller has to drop too, even if they don't want to, even if their boat is perfect, even if they paid peak price. That's why 2 cats that look similar can be priced wildly differently. One seller is competing against discounted new inventory whether they realize it or not. The other seller isn't. One is in a dealer-driven micro-crash. The other is in a scarcity pocket. Okay, now here's the silent killer that turns price volatility into pure chaos. Insurance. Insurability has become a binary filter. A boat that is easily insurable is an asset. A boat that cannot get decent coverage is basically a cash-only hot potato. And most casual shoppers don't understand this until they're deep into a deal and the insurance quote comes back like a slap. Insurance carriers have been hammered by storms, hurricane losses, and rising reinsurance costs. So underwriting got algorithmic and harsh. The "we'll work with you" era is fading. You're seeing age cliffs. For many buyers, the 15 to 20-year mark is a wall, not because the boat stops floating, because insurers stop writing new policies, or they demand surveys and upgrades that are economically brutal. And financing ties directly into that. Banks want that collateral insured. Marinas often require proof of liability. Some require full coverage in certain regions. So if a cat is hard to insure, it's hard to finance, and it's hard to berth. That collapses the buyer pool. And when the buyer pool collapses, the price collapses. This is where you see the 2 identical boats problem. One boat has a clean insurance history, documented upgrades, and it's under the age cliff. It's financeable. That boat can sell to a normal buyer. The other boat is just old enough or has just enough red flags that insurance becomes a nightmare. That boat is now only sellable to a cash buyer willing to self-insure or chase specialty coverage. That is a smaller pool, a much smaller pool, so the price has to drop until it's attractive to that pool. Now add geography, because insurance is also regional. A cat sitting in Florida or the Northern Caribbean is a different animal than the same cat sitting in the Med or New England. In the hurricane zone, you see named storm deductibles. They're basically self-insurance, 10%, 20%. On a $500K cat, that means the owner eats the first $50K to $100K of damage in a named storm event. That risk is real money. Buyers price it in, or they walk away. Then there's the box requirement. Some insurers demand the boat leave the hurricane box during season. If you can't move it, or you don't have a plan, coverage gets restricted or priced into insanity. So owners who are trapped in the box, facing renewal, facing storm season, facing dock bills, become motivated sellers. They cut hard. They create those "why is this so cheap" listings. Meanwhile, a similar boat in a lower risk region can sit at a premium because it's easier to insure and less urgent to sell. So yes, you can see a $100,000 spread just based on where the boat is sitting when you're shopping, not because the fiberglass is different, because the risk profile is different. Now, let's talk about the cost nobody wants to say out loud when they're romanticizing cats: the beam tax. Catamarans are wide. Everyone loves that until they get the marina invoice. Most marinas were built for monohulls. Cats need double-wide slips, end ties, T-heads, special space. That space is scarce. Scarcity means price. In prime locations, cats get charged 1.5 to 2 times the rate, sometimes more. So a 45-foot monohull might be paying $1,500 a month, and a 45-foot cat might be paying $3,000 or $4,000 for the same length. That's not a rounding error. That's a lifestyle tax. And that tax changes seller behavior, because the carry cost of holding a cat for sale can be insane. If you're paying $3,500 a month for dockage, plus insurance, plus basic upkeep, a boat that sits for 3 months just cost you $10,000 plus. 6 months is $20,000 plus. So some sellers drop prices aggressively just to stop the bleed. They'd rather cut $50,000 now than burn $40,000 over the next year while the boat sits. This is why you see sudden price cuts that look irrational. They're not irrational, they're triage. And it ties into maintenance inflation too. Marine labor and parts have gotten expensive fast. Skilled tech rates pushing $150 to $200 an hour in a lot of places. Haul-outs cost more, bottom work costs more, engines, sail drives, electronics, everything costs more. So buyers are punishing project boats harder than they used to. A boat that needs $50K of work doesn't get discounted $50K. It often gets discounted $100K because buyers don't want the hassle, don't want the yard delays, don't want the surprise overrun, and don't want their season eaten by waiting for parts. And here's the nasty survey reality. Sellers love to do cosmetic cash-out refits, new cushions, fresh canvas, polished gel coat, nice drone shots. Meanwhile, the standing rigging is ancient. Sail drives are tired, through hulls are original, deck cores have soft spots, wiring is messy. That boat looks expensive online. Then a serious buyer surveys it and the deal gets renegotiated into the ground. The final sold price ends up way below ask, but you never see that number, so the internet stays full of fantasy asks, and the real market is happening in private negotiations after surveys and insurance quotes. That creates the biggest illusion in boat shopping right now. You're looking at asking prices, not sold prices. A lot of listings are zombie numbers, anchored to 2021 and 2022. Sellers saw one sell for X in the boom, so they list for X plus 10% because they added solar and a dinghy. Then it sits. They drop a little. It sits. Months go by. They relist. New photos. Same dream price. From the outside, it looks like that's the market, but it's not. It's just the visible layer of stubbornness floating on top of reality. Reality is discounts. 10% off ask. 15. 20, sometimes more in the oversupplied segments, especially where ex-charter inventory is heavy, especially where insurance is brutal, especially where dockage is expensive, especially where sellers are time-limited by hurricane season or renewal windows. Now, zoom out and you can see the market split by segment. Older cats, pre-2010, are getting punished hard. Not because they're all bad boats, some are great boats, but the combination of insurance cliffs, financing requirements, and expensive refits turns them into niche purchases. Cash buyers only, self-insurers, people with private docks, people willing to accept risk. That's a smaller tribe, so prices sag toward liveaboard value or salvage adjacent value in some cases. Boats that sold for $250K at the top of the boom struggle at $150K now, not because the world hates them, because mainstream buyers literally can't transact on them easily anymore. Mid-range production cats from roughly 2015 to 2021 are the battlefield. This is where the chaos is loudest. Tons of inventory, charter phase-outs, COVID exits, private sellers competing with fleet liquidations. The same model has wildly different histories and conditions. One is an owner's version with low hours and pristine care. The other is a 4-cabin charter grinder with high hours and worn systems. Online, they look similar. In real life, one is turnkey and one is a refit trap. So you see spreads of $100K to $200K and people call it random. It's not random. It's the story of the boat expressed in dollars. Then the high-end performance and larger segment behaves differently. Outramare, gunboat, HH, that kind of world. Those buyers often have money, knowledge, and intent. Supply is lower, demand softens a bit, sales cycles get longer, but the boats don't collapse the same way because there isn't an ocean of identical inventory. They may correct 5 to 10%, they may negotiate harder, but they don't get dragged to the charter floor price the way commodity cats do. And power cats are their own weird pocket right now. A lot of monohull motor yacht owners are migrating to power cats for space and efficiency. The trawler crowd is looking at stability and volume. Supply is still relatively limited compared to demand in some regions, so power cats can hold value better than sail cats in certain size bands. Again, it looks inconsistent until you realize you're not looking at one market. You're looking at multiple markets layered on top of each other. Now add global currency and you get even more volatility. Most production cats are built in Europe and priced in euros. Exchange rates move. When the euro weakens against the dollar, an American buyer can effectively discount a new boat by buying abroad or importing. That puts pressure on used boats in the US because suddenly a new build might be closer in price than you'd expect.
When the euro strengthens, new prices rise, which should support used values. But if rates and insurance are crushing buyer leverage, that support doesn't fully translate. So brokers and sellers are chasing signals from different worlds at the same time. That's how you end up with two similar boats in different countries priced like they're on different planets. And region matters inside countries too. A cat in a crowded Florida marina with stacks of inventory and insurance pain is under a different pressure than a cat in a low-supply Pacific Northwest harbor with wait lists and fewer comps. Even if the hulls are identical, the seller's urgency and the buyer's options are not. Add taxes, VAT, import duties, shipping costs, and suddenly you're not comparing apples to apples. You're comparing local micro-markets separated by huge friction costs. This is also why all-over-the-place pricing is not going to magically disappear next month, because the forces creating it are structural. High rates change financing. Insurance models change underwriting. Dockage scarcity punishes beam. Charter fleet cycles dump inventory in waves. Dealer floor plan costs force discounting at the top of the ladder. Those aren't vibes, those are mechanisms. And the next phase is even more annoying. The market is shifting toward a compliance economy. Paperwork is becoming value. Maintenance records, documented refits, known hurricane plans, insurance history, survey trails, clean titles, clear ownership history. That stuff is turning into a price multiplier. Two identical Lagoon 42s can be separated by a giant spread because one has a clean digital paper trail and one is a mystery box. Buyers are getting smarter because YouTube and forums and brokers are constantly exposing the traps. So the boats with clean records and recent big-ticket items get treated like safe assets, and the boats without them get treated like risk. And on top of that, there's a quiet future risk sitting in the background: obsolescence. Hybrid and electric tech is creeping into the cat world. Some buyers are already thinking ahead. Not because everyone wants electric tomorrow, but because they're asking, what will this boat look like to a buyer in 2030? Will diesel-only boats get punished in certain regions? Will marinas and protected areas create restrictions? Will green compliance become another paperwork filter? Right now, that's not fully priced in, but the argument is already happening in negotiations. Some buyers offer less because they see future risk. Some sellers reject it because they say the tech isn't ready. That disagreement creates friction, and friction creates spread. So when you see that $150,000 difference between two similar cats, don't ask who is crazy.
Ask, what invisible variable is being priced here? Is one boat actually financeable and the other effectively cash only? Did one fall off the insurance cliff? Is one sitting in the hurricane box with a renewal coming? Is one an ex-charter that set the floor and the other a private owner trying to defend a premium? Is one competing against discounted new inventory from a stressed dealer? Is one in a marina where the beam tax is bleeding the seller? Is one loaded with deferred maintenance hiding behind shiny photos? Because once you start thinking that way, cat prices stop feeling random. They start feeling like signals. Not always clean signals, sometimes messy, sometimes distorted by zombie listings, but still signals. And the uncomfortable truth is this: the market didn't just go down 10% or 15% like a neat chart, it's split. Some boats are still valuable because they're insurable, financeable, documented, and turnkey. Some boats are getting repriced like distressed assets because they collide with hard insurance, high rates, and high operating costs. That's the real reason catamaran prices are all over the place now. It's not a glitch, it's the sound of risk being repriced.